slide. Again, like I said, I'm not an asset-based lender per se. All right? Many of the same rules of thumb that apply to normal working capital lines of credit and how we would look at it are similar. But in your case of from a borrower standpoint and a true ABL lender, they really want to look at the underlying collateral. They're going to do a lot of time up front examining and valuing the receivables and the inventory. And in many cases, you'll have orderly liquidation value appraisers come in and look at your inventory, and they basically say, okay, how much could I get for it if I have to liquidate it? And that's their approach. It's very much different from your traditional corporate commercial lender like Lou and myself. Okay? It's just a different mindset. There's a time and a place for everything. In many cases where maybe you're going through a rough spot, okay, in your operation, cash flow's tight, and the ability for someone within a bank to hand you off to the asset-based lending area may be a good temporary fix until you recover to the point where, okay, I'm back and I'm stable enough to come back into what we'll call a middle market world. All right? But you'll see the terms and conditions, they do vary in terms of terms, and we talk about, what are all the, ingredients for a qualified accounts receivable. You can see them right here. I won't read each one out. For those that have foreign accounts receivable, in many cases, credit insurance can mitigate and provide for availability on that foreign receivable. Okay. Also, we'll look at concentrations with certain accounts. Okay. And it is typically a more expensive form of borrowing. And why? Because there's more monitoring, because they're more concerned about the collateral. They want to value it. They want to touch it. They want to see it. They want you to report more to them. They may want to have dominion over your cash, which means that this cash will come into a lockbox controlled by a bank. And so you have a little less flexibility, but I have other folks that love to operate in that environment because of the nature of their industry. Cash flow's tight, and the bank can work with them. Again, you get an experienced asset-based lender who knows the industry, gets to understand your business, then can become a little bit more flexible with some of those terms and conditions. We touched upon this already in terms of what's eligible, what's ineligible for inventory. Won't spend a lot on that. Obsolete, again, that has to be defined in terms of, how do we define obsolete inventory? Okay. Again, and then the asset-based lenders get in very much into this. All right. Advance rates, that's a perfect point. They do vary widely. And you know what? It really does come down to, you'll be surprised. Some, they have an appraiser come in, and me as a middle market lender, oh yeah, I'll lend you 50 cents on a dollar on your finished goods. Well, guess what? They'll lend, maybe 70, 80 cents because they can readily sell it. And because they can readily, get their hands around it and know what it is, they'll give a higher advance rate. Okay, there's typically a trade-off. You're going to spend a little bit more money in that world. These are critical, and I've seen situations like this where it can really enhance the relationship, whether you're dealing in an asset-based environment or not. You can get agreements from suppliers to repurchase raw materials. I had a situation like that last year, and it worked. It worked really well. They were able to get that, that commitment, and we were able to do a lot more with that borrower. Purchase agreements, can't tell you how many times that comes up in discussion, whether you have, short term, maybe you have no purchase agreements, okay? And again, a lot of clients that are able to get deposits and have less reliance on working capital facilities to support their operations. So all these are really key. in terms of financing your business and getting the best advance rates.